I think this is the first time you've done this on a webinar, Greg?
Yeah. This is the first time we've done a public facing. This is what our clients hear every day when we do calls. But so kind of ready to kind of put it out there. We've watched it long enough now that we feel pretty confident that it's giving us good indications of truth. So that's what we're aiming for.
Yeah. So Greg and I talked about doing this back at a mastermind meeting earlier in the year, where he was presenting some of the results of a model that he's developed and been tracking for a while, of kind of aggregating 100 companies that are clients of his firm across, all sorts of industries across the country, different sizes. And full disclosure, we are a client of CRI and Greg's firm. But what I thought was really interesting is some of the results were starting to really show trends in the economy that I think we're going to see play out. At first, I sort of thought about them. We talked a little bit about, the macro today, what's happening. And I think it's relevant for that. But what I think you're really starting to see is a long-term trend that's going to play out over the next decade or more, rather than, just over the next year or so. So I think it's a really important thing for business owners to start digesting. And I think at the end, we'll talk a little bit about just some of the implications of that for business owners. And if you want to hear my take on it, I'm doing a little blog tomorrow, a little video blog on my Substack. It's thenewrules.substack.com. And that's going to be more about what I see happening over the next year. But I think what Greg's showing today is really going to be the trend we have going forward. So with that, we'll start our presentation.
All right. Let me share my screen here and see if this goes to the correct screen.
By the way, guys, if you don't know Greg, most of you do, but he's the man, the myth, the legend, who wrote Simple Numbers and taught a generation of business owners how to manage labor and manage their businesses.
Yeah. All right. So like Alan said, I mean, this comes from when I was writing the Simple Numbers 2.0 book. It was kind of something that I picked up and put down over a series of years. But I started doing some research, started back in 2013. It was actually I get to chair the EO at Horton Executive Ed program, and talking to our lead professor for that program. He was sharing some interesting data, with public companies, but he didn't have access to private company data. And it really, kind of opened my eyes to the opportunity to start studying data that we had access to. And one of the kind of the features that makes it easy for us to do is because all of our clients' data comes in one format. Once we go through and put it in our Simple Numbers model, it makes data aggregation a lot simpler of categorization and consistency across a study group. And so starting going that direction at first, and then as we've watched it, started sharing some of that information in my talks, and then started sharing it with clients on a monthly basis when we do our monthly calls with them. And I really felt like it was time that we could really share this openly. And then especially as we went through COVID, I mean, all kinds of stuff really kind of changed. And so I've started, kind of developing more of at the beginning of a lot of my talks, I do more of an economic update before we start talking about business models and profitability and capitalization. And so, this is kind of a summary of some of the folks that have heard my presentations. You've probably seen some of this, but these are adapted to kind of our read of the market, at the moment based on what we see. And so this is kind of my overarching look at the state of business that, you might, I'll make some provocative statements here. We can debate them. I mean, these are just my opinions based on what I see, but I'm in the camp that believes that we probably have come pretty close to true global economic output, probably peaked in 2019. And I'll show you some data a little bit later of showing why I think that, but essentially we started seeing labor becoming a problem pre-COVID. It just, COVID became an interruptive event that threw off everybody's trail of understanding comparability of data, which is really the second bullet point here, is that a lot of people have lost their sense of their evaluation of business models at the moment. because of COVID. And some businesses did great during COVID. Some businesses did worse during COVID. Some businesses were totally unaffected by it. And so, from that standpoint, I can have a great appreciation for the economists and the data trackers of the world that are using publicly available data, which is one, heavily filtered, and number two, not really, in my opinion, a reflection of the true economy. Because we have definitely become a very private company centric, economy, more so in the last 20 years than we were, in the previous 20 and 40 years, since the Great Depression. Another statement, we'll talk about this some more, inflation is real. It's going to continue to challenge your pricing strategy. Now, early on in COVID, as labor really heated up and had supply chain issues and people could really charge aggressively on stuff they had in hand, what they realized though is they were making obscene profits for stuff they had in inventory, and they lost money on the stuff they had to reorder because of excess shipping cost, increased labor cost, and all of those things. And so we have a lot of companies that have kind of went through the spike and the drop and then kind of restabilized, point of that. But at the end of the day, one thing has been constant. Labor has continued to escalate in price, and there's not excess labor. And so when there's not excess labor, wages will continue to rise. And, and it's a good thing to not have excess labor, but it does present a thorny challenge to people who are constantly, keeping inflation under control as their focus. I got news for you. You probably can't have both of those things, in the same market. So you got to pick one or the other. I mean, this labor shortage is permanent. I'll show you some slides later that I got from Peter Zion's work on the geopolitical environment. It is one of the biggest overlooked issues is the population demographics of the world, both the developed world and the emerging world. And those emerging are not necessarily emerging anymore. Even their birth rates are falling. And, you've really got kind of two camps of people who talk about population. The UN has kind of put out these population statistics for years that are just grossly overstated. And there's a group of thinkers, Zion's, one of these included, that really believe, hey, we're kind of at peak world population, and we crossed 8 billion people likely last fall. And that's about it, folks. I mean, it might go up a little bit from here, but we're not getting to 10 billion like they said. And really the challenge is we don't have an economic understanding of what a declining population economy, how it acts. And all of us are just going to be guessing and theorizing. And so it's going to present a unique challenge. And much like, Alan's material where he talks about the new rules, I'll agree with that. There's new rules to the game of business that we're playing. And we weren't given the rules. We're going to have to move the pieces to figure out how the game is played and learn it on the fly. And that creates some challenges, in the marketplace.
Yeah, one note I was going to make there, Greg, and Todd on the Q&A was talking about coming back from a furniture show, and saying that, there were a lot fewer people there and manufacturing really ramped up. But the manufacturers are looking for business now. And so
Yeah.
I think what you're seeing is your point there is that CPI measuring all inflation, probably a lot of goods inflation is coming down pretty quick, but that core, what they call the personal consumption expenditure, X housing and food, I guess you can X a lot of stuff, but it's really services, labor.
Right.
That hasn't changed in months. So.
Yeah, and we've become overly focused on things in measuring inflation, which are much more, inclined to fluctuate. Because we've got clients right now that their China suppliers are telling them, "Hey, keep ordering, and we'll hold the excess inventory for you, and you won't even have to store it somewhere." Yeah, you haven't heard that from any of them in a long time. So if ever, so yeah, but it's. We haven't seen a break in pricing yet, but there's a good chance that over the next 6 to 12 months, you're going to start to see some aggressive price cuts, for them to want you to keep up production. But even then, they've got some other issues of where, there's other high demand items that they're not able to keep up with.
Yeah.
So it is kind of it's a lot of crosswinds. I mean, you don't have one common theme, in the marketplace. And this kind of ties into supply chain issues. They're going to continue. I mean, if you're, I was talking to somebody the other day that has a construction project, and they needed a certain amp electrical box, to finish the renovation of this leased out space. 9 months waiting list. Everything's done except they can't do the electrical because they're missing this, some some odd amp electrical box. Fortunately, a lot of housing development was being held up by transformers. At least now, most of the housing development projects that the track builders were building, they've all stopped those. So, but I still think it's probably difficult to get a transformer. So you got some of those kind of things that are still kind of weird out there. My HVAC, clients are still telling me that there's critical equipment that they're still back ordered anywhere from 6 to 12 months, on some of that equipment. And a lot of this stuff is sourced out of China. And so the crap that we don't need, yeah, you can get that, but the difficult stuff, it's still delayed, and they're having trouble continuing to make it. And so those things will continue. The M&A market, and Alan, you might want to add a comment to this based on where you were last week, but we continue to see it to be active, but we're seeing some sharpening of the pencil on prices being offered. There is a lot of market chatter about leverage deals that are going to go bad because with the prices they paid, and this goes back to the core of Simple Numbers 2.0 discussion of the models that I show in business valuation, they can't cash flow. And so when businesses aren't profitable, there is no cash flow that you can make that debt service. And when you pay a 10 times EBITDA or more for a company, you better have the cash. If you leverage those deals, there's a high probability that you're going to go into default. And most of the feedback that we're getting is a lot of the businesses that were purchased do not operate better once they're purchased. And so they've got that going against them as well. So but it's still to say this, there's still a lot of money out there, and the smart money is still ready to do deals, but you got to be armed with your decision of, is it right to sell or keep?
Yeah, I mean, so Greg was referring, I was at an M&A conference last week, and there were a few PE people there and some investment bankers and some lenders. And so the first stat that was really shocking to me was one PE person was saying that they've seen $1 billion increase in debt service over their current portfolio just by floating rates. That they did not reveal how big their portfolio was, so I don't know what percentage that was, but still, anything with a B is a big number. So
that's a big number.
That's making it scary, and that's before any real degradation in revenue or net income, right?
Yeah.
And then the other was from a lender who does sort of $25 million EBITDA and up, so a little bit larger in the mid market. And his claim was that things are frozen. Like a lot of people are talking, but just the numbers have gotten so high and seller expectations haven't changed. So it's a little like the housing market, really, kind of frozen.
Yeah, and I'll point people to, if you're in the middle of a transaction, so in the Simple Numbers 2.0 book, there's an example that we use with our clients who are thinking about selling. We call it the replacement return decision, of essentially how to evaluate, when is an offer a green light or not. So, and that has really helped a lot of our clients gain clarity of whether even to remotely entertain, an offer. But I will tell you that more offers, for the last 2 years, most of the offers were coming in right at or better than the green light indicator. I've seen more deals in the last 6 months that I would say 9 out of 10 questions I've had on it are red light indicator of saying, listen, this business is better in your hands than it is to sell. And so So that kind of gives you an indicator, the market, situation. One thing I always like to remind people, and we get over fixated on the public stock markets, and yeah, I mean, it's not to ignore them, but one of the things you've got to remember is, if you go back to 2000 and look at how many public companies were in the public markets in the year 2000, look at the size of the market, and you forecast that forward, there should be twice as many public companies today or more than what there are. And and say, well, what happened? Well, it's this private equity is what we just talked about. I mean, there's not a need to go public to get liquidity or get the price that you want, that you used to have to go public to get that bigger multiplier. Private equity has been willing to pay for that. And and so it's really sucked out a lot of the quantity of available public companies to invest in, which largely leads to why the public markets are generally overvalued almost at any time, in recent history, is because you've got a supply and demand problem of you got too many people that need to buy public stocks because of 401k investment. And there's only so many stocks to buy. And so those mutual fund managers, whether they will say this or not, the reality is they're buying the least ugly stock every day. And so that least ugly stock becomes an ugly stock as they buy too much of it. It goes down to the bottom, and the next least ugly stock comes back to the top. And when the market goes down one day, give it 2 or 3 days. I mean, you go back and watch this, for the last 10 years, every time it goes down, guess what it does? It comes right back up. And it's because the next week's 401k deposits got sent to the money mutual funds, and the mutual funds need to buy something, because we've not had an active alternative investment of a bond market, in quite some time. Now, with interest rates up like they are for the first time in a long time, maybe some people will remember that there is such a thing called a bond that carries interest instead of a stock. Unfortunately, you got a whole generation of investors that know nothing about how bonds work, much like kind of the managers of SVB and didn't understand how bonds work, when they screwed up the bank. But that's really kind of what causes the public stock market price to earnings ratios and all those things are nonsensical because of supply and demand imbalance. And I don't know whatever gets that back. I mean, unless there becomes more publicly traded stocks, that's probably going to exist for some time. Basically, at the end of the day, I know these are a lot of challenges, and I don't want to be, just all about down, down, down. But there's going to be economic disruption. But guess what? It creates winners and losers. And I mean, the last recession, I would say 2009, 10, and 11 were 3 of the most profitable years our clients ever had. And if you're a well-prepared business, then you will be the winner. I mean, we're going to have, this is going to be the time of the greatest separation of the herd in business that we've seen for quite some time, if not ever. And so those of you who want to run a good business, run a great business, you're going to stand, a greater opportunity. Now, there are some industries that just won't let you run a great business. If you're a residential real estate brokerage business, you're not just a broker yourself, you run a business that houses other brokers. That's a tough business right now. And there's not inventory and there's not buyers. And so you can't be profitable in it. Yeah, pretty much not. Yeah, it's almost impossible. If you're a mortgage lender, you can't be profitable because there's not mortgages of a sufficient quantity being issued to be profitable as a mortgage lender business. And so those are both tied at the hip, from that standpoint. But the vast majority of our other clients, I mean, there is availability to be profitable, but some have greater demand than others. And you have to kind of decide, where your business fits. Are you in that necessary business? Are you in a highly desired discretionary business? Are you in one of those businesses that people can do without? And you got to really say, okay, well, I've got to kind of hang in there or find something else that becomes more desired, to sell as a product or service, than what I do. One of the things, so going back in time, let me show you kind of a data set. So this is my issue, and you've seen a lot of people. Elon Musk has made a couple of tweets lately, that kind of echoes this same sentiment that this graph does, in that the Fed's data is very latent. It's behind, and it may even be questionable, because when I started tracking this back in 2013 was my base year. So 2014 was the first year I looked at this model, and my client base of this model grew at 20% year over year revenue. And it's not adjusted for inflation, but inflation from 2014 through 2020 was somewhere around 2 to 2.5%. And so you could pretty much use year over year revenue is at least a decent indicator of growth, in that time frame. But the federal government's reported GDP was somewhere in the 2 to 3% range for all of these years, and through 2019. But the first couple of years I tracked this, I looked at it and I go, well, mine's 20, and they said 3. Okay, well, it's probably just this particular group of clients. Well, the next year those clients were 14, and the government said it was 2.5%. Well, the next year it was 15%, and they still said about 2.5%. The next year it's 23%. The next year after that was 23%. And what I came to realize is I don't know that they have the ability, they don't have the data, to be quite honest. I don't really know where they get the data, because we actually had a Fed economist come over to my EO forum in Atlanta a few years ago, and it was a nice chat, and we were talking, and I just kind of asked her the subtle question of, hey, where do you get this private company data? How do you factor that in? I know you can get access to public company data. She says, well, every Fed governor has about 10 or 12 businesses they call and talk to once a quarter, and to see how things are going. Really? And so somewhere in the bowels of the government, there's this statistical analyst that's never made payroll in their life, that is taking publicly available data and statistically smoothing it so it doesn't ruffle the markets. Because when you take that GDP number and you move it 1/4 of a point or 1/2 a point or even a whole point, the marketplace goes crazy. And so we built a system that is almost intentionally in error, because we're afraid of ruffling things and afraid of dealing with the truth, in that regard. And or at least that's my belief. But there again, as I like to say, what do I know? I'm just a chicken farmer from Alabama, but hey, I got this data and it tells me something. Now, here's a couple of interesting things. Now we roll along, and this chart from 2014 through 2019 covers a Democrat in the presidency and a Republican in the presidency. And, my opinion is, listen, we give them too much credit and we give them too much blame. At the end of the day, entrepreneurs are pretty good at figuring out how to make any system work. Now, granted, they make some unnecessary headwinds that I would love to see it not happen, but for the most part, we're pretty good at figuring things out. But notice this, in 2019, my data showed 8% growth. And that was the beginning. That's the reason why I made that first statement, that global growth paused, or it kind of hit the lid in 2019, because we ran out of labor. If you go back to the fourth quarter of 2019, we're already at almost historically low unemployment rates even then. And people were struggling to find workers. People were struggling to not be poached from their labor. And that just kind of continued once we got through the initial shock of COVID. And then you see the spike that happens out here, in 21. This is shortage of labor and a recap of this, kind of pause of the market. And you can see for the vast majority of businesses, if you weren't held back by lockdown purposes, you were rocking along pretty good if you could get the labor. But just in the same as that growth took off, that growth has kind of hit a wall. And we started seeing it, and I'll show you, kind of some nearer term data here. This is the inflation graph. Let's go to, I want to show you this. And so this is the rolling 12 data. So this is a 2-axis graph. Revenue is the left axis, labor is the right axis. So revenue is the blue line. And so as we start to see here, when labor exceeds revenue, and the way this graph works, it's telling you that labor is leading and revenue's chasing. And so pretty much back here in 2019 is where revenue took the lead, and we kept having to readjust pricing, to catch up. And, you have a little bit of dip here because of COVID. And then all of a sudden, once we pass lockdowns, it starts going up. But this isn't real growth through here. This is inflation. And then you have an inflection point here in the early part of 21. This is where we really believe inflation just went straight north. I mean, it took off like a banshee. And that's really where, the marketplace was fragile enough. There was enough, free money sloshing around in the economy that you pretty much had free cover to raise your prices and try to catch up. And it did finally catch up out here towards the end of 21. But then the Fed says, oh, wait a minute, this is too much inflation. We've got to beat it back. We've got to raise interest rates. And notice here that, once you get to April, this is when the Fed started, hitting their interest rate policy, and the rolling 12 now is flattened out, and it's been flattened. The problem is labor continued to go up. Now it is slowed and it is flattened a bit, but we're still seeing, that constant, push on that. Back here, you can see this is the other inflection point of this gray line is non-labor operating expenses. So kind of like the general noise of business, not cost of goods sold, but kind of just the general business expenses, that are there. And this, from this point forward, is just pure unadulterated inflation. Now, what this means to the bottom line is this: profit got stuck right here in the middle of 21, and it's flat. So revenues are going up, but profit dollars, didn't move.
So Greg, I think
that's a challenge.
Just looking at it, the concerning thing really is as you go, you didn't really see, when you had that acceleration in 19, you didn't have the other OpEx acceleration as well.
That's right. That's right.
Now
you generally gain. That's usually a nice opportunity for you to get some leverage off of those costs and get more utilization of them. But that's not happening right now.
Right. So it seems like we're trending toward where that yellow line is going to start going down, and that's going to become a problem.
Right. And
that's the skunk in the wood pile, right?
Yeah, we call that a skunk in the wood pile. Yeah. and so this is a little more sensitive graph. So this is rolling 3. Now, rolling 3 data, this is not adjusted for seasonality, but this is just raw data of these companies. On every data point represents the 3 months of data at that end date. And you can see there's always some waves in that. And you'll see this, everybody always kind of noticed in the profit number, there's a down cycle in December. Regardless of all the things I've written and all the things I've talked about of entrepreneurs doing stupid things like spending $1 to save 40 cents in tax, they still do it. And so that down curve is always what happens at the end of the year when they're spending money. They lower profitability. I mean, these are legitimate lowers, but still they're making discretionary purchases of saying, well, if I'm going to pay that much in tax, I'm going to go ahead and spend some extra money on marketing or hire an extra person or buy this or buy that that the business needs. All well and good. If you look at the revenue number, though, the revenues go through these little waves, and so you can see. Not really much of a dip here in the COVID cycle. And then once we got out of the lockdowns, they really popped back up. A little bit of a down cycle towards the end of 20, as everybody kind of got off of the drug of PPP money and all those kind of things. But then early 21, you see this amazing spike of activity. And then market kind of stabilized, and it says, okay. And a lot of this was the fact that, people were struggling there. It wasn't for lack of demand. It was for lack of labor. So you can see they kept spending more money on labor to try to get this out. One of the interesting things, and I'll show this in the hard numbers here in a second, is all of our data points to that COVID has really done a number on labor productivity. And so for every, and I look at labor productivity not as how much a person can get out. For every dollar of labor I put in, how much margin does that labor help create? And as we've measured our signature LER or labor efficiency ratio across this time frame, we're still not back to pre-pandemic labor efficiency numbers of output. And part of that is obviously inflation of wages that I couldn't pass through the price increase. But part of it too is also just worker productivity and attitude and commitment. And plus we're down at the bottom of the barrel of available labor. We don't have any excess labor. And so you have a higher, and this is not a popular statement, but I'm sorry. There's a lot of people working who normally, would be under a performance improvement plan. I mean, I've asked this question all around the world. I've done some international speaking in this past year, and I don't care where you're from. I ask this one question: how many of you have not reprimanded a poor performing employee because you were afraid they would quit because there was no one to replace them? And 75% of the room raises their hand. That has never been the case, ever. And so granted, I mean, the workers kind of have the upper hand. I get that. Now, here's the thing. As we roll forward, this is a constriction of available labor. And so we take off again. They build up some labor so they can take off again. And part of this is price increase. And hey, we found some new labor. We just pay whatever it is and we'll adjust the price. And then boom, Fed starts changing interest rates right there. And guess what happens to the rolling three that we've been on since May of last year? Down, 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 down. And we've seen a little stabilization in January and February, because this is data through February of 23. But I think March is going to come in. We're going to have March available here in a few days, but I think March is probably going to be still in that stabilization, might be up just a tick, but I'm telling you, it's put a damper, but yet it hasn't cured inflation, because inflation is a different issue. It is labor will continue to increase in price until there's excess labor. And
Yeah,
it just is what it is.
I can say just from our experience, we are throwing everything in the kitchen cabinet at hiring labor over the last few months. So last year, it's been rough, and some of that profit decline, right, is going to be you have a little profit spike there at the beginning of the year, but probably some of that is deferred profit from tax purposes going from December to January, right?
Right. Yeah. Some of that is just a slight movement, especially once you get to rolling 3 data, it becomes a little more time sensitive. Once you smooth it out and dealing with rolling 12s, it moves, pretty consistently. But here's kind of the raw data. At first, what we were seeing in 22 is, we were at 55% gross margin pre-COVID. Well, that had dropped to 53.8% in the 12 months ended February of 22. And that was just pure pricing of goods, pass-through goods. Everybody kept getting hit with, hey, my cost of goods that I bid on a project just came in more expensive and I couldn't pass it through to my customer. And so a lot of our clients were getting hit and on the chin of price increases they couldn't pass through. But whatever you get in gross margin is more important when you look at the gross margin to direct labor. This is this direct LER. So just looking at direct labor alone, we were at a 283. So what that meant was pre-COVID, we would get on average $2.83 of gross margin for every dollar of direct labor invested. Well, we've been in the 260s ever since. So that's a 20 cents, off in terms of that productivity. And, we're still not catching up. And then you can see in the rolling threes, we caught up a little bit. We're up to 269. And this is just, where people have really kind of said, listen, it's about getting profitable. So notice what happened here is they stopped adding. And so revenue actually is down 0.2% this rolling three over the same 3-month period the previous year. When there's a negative sign, folks, that means there's not growth. And oh, by the way, these are not inflation adjusted. So the real downward number is probably 7%, in terms of raw output. And here's the thing for everybody listening to this. I mean, how do you measure output? Because it's not revenue dollars, because you didn't charge the same price likely in both years. And so you didn't have the same output. And we've become an economy that is exceedingly difficult to measure output. I've got a few clients that can measure things in pounds or feet, or those things. But for the most of us that are in the services industry, you can say, well, billable hours. Have you watched the humans that bill hours that work for you? I'm telling you, those hours are not the same output, that you had before. And so it's a difficult thing. So I give I give some latitude to the economics people who are trying to put out data. I appreciate them trying to put out something. And mostly it's kind of telling you maybe the direction things are going, but it probably is a poor quantification because these are hard numbers to know. Now, the good news for us is we've touched every piece of data in here. So we've organized it. We have consistency of classification of how we believe it works across each of these businesses. And every business gets a P&L in this structure of the simple numbers model. So I think we have some semblance of, we have a lot more comparability because we've touched the raw data itself and certainly looked at anything that we can leave out, companies that, are anomalies or, create, large distortions. But it's really, a challenge, that we're concerned about. Now, as we move down, the biggest issue that's affected profitability though is management labor. And so when you look at management LER, we were at 339 before. We actually did good in management labor in the first 2 years in COVID, got up to 378, 383, but now we've fallen back to 347. Two factors are affecting that. One is people staffed up believing that growth was going to continue prior to the rate increases. And so a lot of companies are in kind of the trim mode now. Even our clients, I've had more discussions with clients in the last 6 months of trimming unnecessary labor to get profitable because they advance hired just like the bigs did, the logos did, and you're not going to get there, in that regard. The other one is a simplistic number, total labor efficiency. And really, I've kind of gone back to I talked about total LER in the first book, kind of gotten away from it, breaking it down between direct and management. But really, I've kind of gone back to it of late more so. The number that we believe affects probably 90% of the business models in the U.S. economy, or really the world economy, is a 2. I need to make $2 of gross margin for every dollar of any labor, regardless of what it does. And that kind of leaves you open to the strategy of, well, I can be heavy in direct labor, but I got to be skinny in management. Or I can be balanced between the two, or I can be skinny in direct labor, but I got to have more management to make that skinny direct labor be effective. And the reality is we've got clients in the same industry that deploy different strategies of how to manage that labor mix. And so when you're looking at benchmarking against other companies, you kind of have to understand what is their playbook before you really analyze their numbers, because at the end of the day, they all got to come back to the 1.9 to a 2.1, but the average is 2. And if I take this 100 company model and I strip out the 20 worst labor efficiency companies and leave it to the best 80, this total LER is a 2. It's a crazy consistent number that, short of, there's a handful of businesses that can live below that, not very exciting, but there's if you're in retail or you're a distribution business, those have a tendency to be probably 2.5. But from pretty much 90% of the rest of the marketplace, whether you're manufacturing, service, blend of the two, product plus service, it's a 2. I mean, I've got a $45 million chemical client, and we spent a day with them. And I said, well, guys, at the end of the day, I'm going to give you one number, 2. All you need to know is 2. So your salespeople need to sell $2 of gross margin every week for every dollar of labor that you have in payroll that week, regardless of what that labor does. And if you do that, you're golden. Anything below that, you're underperforming.
Yeah, my experience with this is right on. I mean, we saw direct labor go up first. That's what really escalated in the beginning, and management was a lagging.
Yeah, it was lagging. Yeah, absolutely.
Now we started just the end of last year. You see a lot of poaching going on, and so it definitely started escalating.
Yeah. So notice this at the top, and so this is the trends that you're looking at. I mean, wages in 22, year ended February of 22, so mostly of year of 21, wages went up, total wages went up 26.8%, revenue went up 35.7. But this year, revenues only gone up 7.3, but wages have gone up 12.6. And even in the 3 months, wages are still going up this quarter over quarter. There's still upward pressure. And the thing is, a lot of people are keeping the wage number down by flipping skill set. And so you're taking your most expensive people and letting them be poached and just accepting, I'm going to go with a less expensive person. And one of the reasons why pretty much every place you walk into these days sucks in customer service is because that's exactly what they've had to do to be economically feasible. You can't afford, the folks that can afford the top labor, either they're in a protected market that they can get it. But, a lot of them, those are the walking dead companies too, that are going to go out, at some point. So we talked about those. Let's see if I wanted to cover this chart. So you mentioned this earlier. So this is a great chart that I picked up, and it essentially covers, if you look back from the year 2000 to 2022, so 22 years of segment inflation. These are the items that become more affordable because of how they get produced, and these are the ones that become more expensive because of inflation. What's the old thing in kindergarten of what's the one thing that's not like the other? These do not require U.S. labor. These are all done as imports externally for the most part. All of these require U.S. labor, with the exception of the total fraud that is college tuition and college textbooks, and leave that for a discussion for another day. But basically, all the other stuff is labor. And listen, I mean, you probably caught on by now if you hadn't heard me before. I'm a labor guy, and labor means there's nothing productive that happens in the world without labor. And so therefore, hey, you better pay attention to the spread that you get of margin relative to labor. But when you run out of labor, there's no upside. And the challenge is we've got a population problem, that is going to create issues. And so pretty much, when you look at the law of supply and demand, when there is greater demand than there is supply, prices will go up. Well, that's the labor market that we're in. This is the first time in U.S. history ever that there is no excess labor in any category, in any geography in the U.S. Now, there's signs that we're about to crack in some of the areas of the country that are negative migration, to the south, and you're going to start to see it there. But all of my clients in the southern states, I check with them every call, and labor's not plentiful. It is expensive, but they also still have growth, but it's not from general overall market growth. It's from migration growth. And that's what's keeping, those areas and those markets stable, and moving along. Here's the big bugaboo. This was from back in December, but I think the numbers are getting fairly similar. I didn't get a chance to pull these to update it, but we had 10.4 million open job postings in December. It was a high of 11.8 in March of 22, 5.7 on unemployment in December, so that's 3.5%. Since then we dipped to 3.4. I think we're back to about 3.5 if I remember correctly. But the big issue is this. I mean, we had a 2.4 replacement birth rate in 2001. We're down to 1.7 in 22. Most people think we're at 1.6 and dropping quickly in 23. And that is a big problem. It takes 2.1 to have a stable society. And so I contend that what caused the 2019 evaporation of labor is my generation. So all of my peers have retired. I mean, I'm the crazy one that keeps working, but everybody I came up with, they're sipping mimosas and thinking about playing golf. And, but I like what I do. And so, but, it's widely known that, you make the most money and you're the most productive in the last 10 years of your working career. And from 2010 to 2019, that was the swan song of the baby boomers. And we've said, see ya, and it's up to you now. And they ain't enough of you. And we're still putting demand on the economy right now, probably more so than any previous generation. The baby boomers are spending more in early retirement than previous generations. And so that's creating a little bit of the excess demand, both in goods and services at the moment, but that's going to fall. And if they take a hit in the stock market with their investment portfolio, a lot of them will really, crimp in terms of their spending patterns. But we don't have a productive worker economy, to replace it. This is from Peter Zion's work, which I'd highly recommend everybody check out. We have the inverted pyramid. And so when you look at the millennials down to, and this 2025 group is not going to happen. That number is going to be probably closer into here, because based on the early indications of birth rates over the next couple of years, we may be down in China territory if things don't pick up soon. So it's a major issue. Now,
China, right?
This being said, well, here's if you want what's really bad, here's the China version. Now, the yellow is the official reported number. The red is actually what they expect to happen, and China's known to not tell the truth about these things. But China is down to 1.1 replacement birth rate overall in the country, 0.7 in the urban areas. And if you listen to guys like Peter Zahn and his predictions, and he's got a couple of interesting just direct podcasts just on China that, I mean, if you are dependent on China directly, critically for operating your business, you can't start soon enough to find an alternative source in another country, to figure out how do I source this because one of two things can happen. I either get blocked based on political reasons that I can't access it, or two, they're running out of workers at an alarmingly fast rate. And once again, like I said, the general crap, yeah, they're still making that and they're being aggressive. But the hard to make stuff is where you start to see the cracks, and they don't have the people to keep those factories manned and will continue to keep them manned. And that's going to be an issue. And you've already seen Tim Cook trotting around the world trying to find some other place to move his iPhone factory, and other things. So, we got some interesting stuff. And some of the industries, I mean, one of the things we like to look and turn the blind eye to is we get China to make all the nasty stuff that we don't want to touch in the US. We just want it to get cleaned up over there and brought here, when it's not toxic. Those are going to be the tough things to move. And there's a lot of that kind of stuff in the product and the manufacturing world. But I mean, our manufacturing clients here on shore have just been booming. And, they're, even with slowing demand in the general economy, they're double and triple of what they were doing pre-COVID, just because just a little bit of movement that we've had already. And we just don't have the capacity to take, it's hard to build it fast enough. And plus we're going to have a labor problem, of how we deal with it. Right. And so really at the end of the day, you got to deal with some things that, to kind of address this. So a couple of things, the kind of, key takeaways, and, Alan, feel free to add your comments. Yeah. I mean, number one is we're pushing our clients to get back to pre-COVID labor efficiency levels. I don't know, some of them will never get back there. Just the worker attitude, the availability of workers, what you have to do to work with things, those are difficult. And so every client that we talk to, I mean, pretty much all three of these things come up with just about every call. How do you automate it? How do you offshore it? How do you train it? And really things like even ChatGPT. I looked at a session this week with a friend of mine, and I was really amazed at how quickly it could take content and create a test to validate what a worker needed to take a test to validate, did they learn anything from reading the content, which I thought one of the biggest barriers that we have to our clients creating their own training material is actually creating the test validation. Guess what? ChatGPT solves that for you, so don't worry about it. You got a tool to do it, that is essentially free. Like Alan talks about, learn the new rules to the game. There is no playbook. We're going to have to probably start our own little back channel chat group to pass along what we learn, as we see it move. But I got news for you guys. When population is stuck to declining, the physics are this: the economy cannot grow. Let me repeat myself. When labor is stuck to declining, the economy cannot grow because there's no labor to make it grow. Automation, I get it, but this isn't the bubonic plague ushering in the industrial revolution. All of the low-hanging fruit things, have been taken up. I mean, so I was talking to my sod farm client before this call, and we were talking about Chat GPT, and I said, "Hey, can Chat GPT go cut sod out in the field?" No. Okay. Well, I got news for you. I mean, it still takes people, to kind of go do those things.
Well, and some people are saying, we'll see this real escalation in physical industries, right? So kind of switching back that inflation narrative, and maybe
Yeah,
some of the white collar stuff gets more
yeah,
automated and outsourced.
right. That's right.
But
And
I think,
but
as we've talked, I think that's just going to take a while, right?
yeah,
It's not going to happen next year.
what it's going to be right now is called fire all weapons. And so
Yeah.
the people who can outsource need to outsource. The people who can automate need to automate and leave the available labor for the things that need humans physically here. The problem is we don't have the right match of the human to the thing. And that's really where a lot of these settling out, and that's where a lot of the economic disruption is going to be, is where I will eventually have some excess labor in some categories with excess jobs in other categories, but the two don't fit.
Right. And
And
I saw IBM today, I guess they said they're going to lay off, I think it was 7,800 people,
mm,
and they're going to replace them with AI. They didn't say specifically ChatGPT. But then I looked up their workforce, it's 345,000 people, so we're
yeah,
not talking a
it's a
significant
rounding error.
percentage.
Yeah, that's right. And most of those people will find jobs fairly quickly
Yeah.
because there's plenty of other companies that may not be exactly one-to-one same pay and benefits, but it's close and it won't be much different. Obviously, I talked about you got to evaluate China as your critical resource if that is the case, and you got to start working today on alternatives, and you got to put this in the front of your thinking. You can't stick your head in the sand and think that this is going to go away. This is a problem that got built 20 to 30 years ago, and we're just living at the inflection point of it. You got to get profitable with what you got. If you're in one of those industries that is interest rate sensitive, or it's a low demand item in a discretionary spending, part of the economy, you either have to find something else to do, or you have to hunker down until the demand comes back, or you've kind of got to adjust your business down to predictable demand and then stretch whenever you have those spikes, versus you can't stay up there at that higher level and expect to maintain. And then once you get profitable what you got, our big thing is get fully capitalized, which means zero drawn on a line of credit, 2 months of operating expenses in cash. And our clients who are in those positions are better prepared to go through these disruptions. They're not worrying about a bank pulling their line of credit to operate, in those things. And so, I've really been proud of what we've come up with to help those clients quantify that number and know it and operate to it. And they have fared well. Really, at the end of the day, if you were going to solve things, we got two major problems. Number one is, we still have issues with this banking crisis. There's all more rumblings today, out there. And to be quite honest, to me, it's a simple fix. You just need to come out and say all deposits are FDIC insured. It is not hard. Doesn't cost us anything in reality to say that. And oh, by the way, if you say that, then why don't you do your job and go regulate these banks and make sure they don't do stupid stuff that a first grade bank manager would know how to do, such as invest long-term low interest bonds to offset volatile deposits. I mean, I knew that. I was a 26-year-old CPA as a controller of a bank back in 1983, and even I knew that. I mean, it's like, come on. I mean, this is kindergarten banking, and it's like people are not doing their job, and so anyway, kind of ticks me off. The
Well,
second thing,
oh, go ahead. You finish.
well, the second thing that solves it, and this is not popular either, but if you want to solve inflation, there's one simple answer. We need to have the greatest America's Not Got Talent show. So instead of America's Got Talent, it's like, no, we don't. America's Not Got Talent. We need to bring in about 2 million of the best and the brightest with immediate citizenship from around the world across every short-staffed skill set that exists, which is everything in the US right now. And there's 2 million people that want to move here that would take those opportunities rather than indiscriminately letting people come across the border that don't really fit the need. That's a totally different issue, you know. But until you have enough labor that unemployment is, I mean, it's long been believed when unemployment is below 5%, you're at full employment. There's 5% of the workforce that is just unemployable. And that's not my problem. But if you want to have low inflation, it is a labor problem. It's not a interest rate problem. But there again, I will give you the caveat. What do I know? I'm just a chicken farmer from Alabama.
So we did have a question for the chicken farmer on what we can
Okay.
do to move the birth rate up. And I know you've been struggling with your kids. So
Yes, and fortunately, I was informed that we've got one in the oven. And
congratulations.
so what worked for me is as a parent, I paid for my son and daughter-in-law to go to the beach for a weekend vacation, and my wife and I kept the kids, and so that worked.
That worked.
So yeah,
So
it did.
can we scale that, do you think?
I don't know. I mean, you know, it depends on how willing, you know, but it's like, you know, you kind of just put your requirements out there. You know, but I mean, you know, the one number that you know is counter when you look at the population grids that Peter Zahn puts out in his stuff. You know, France actually has more of what they call the classic chimney stack, you know, model. And I mean, it's hard to draw direct correlation, but the belief is France actually has a more stable birth rate because they do provide stipends for childcare.
Yeah.
For two-wage earner families. And like I said, you can get in an argument all day of this, you know, this or that. But you know, if you talk to young people, the first thing out of their mouth is kids are expensive. Yeah, of course they are. You know, but a lot of it is also just facilitation. I mean, I know what my kids go through to, you know, manage them having kids, and it is a barrier. And so, you know, I mean, there again, but those are practical things, you know, that you know, I think are you know, that can be looked at, whether it's, you know, we spend a lot of money on a lot of other stuff that I'd rather redirect on something, but we've got to get it out of our mind that we're not headed towards overpopulation. We're headed in the other direction. And you just paint any scenario you want of what a declining population does to an economy, and you're not going to like the answer.
Yeah. And really the problem we have is, I mean, we can do immigration, right? But we're stealing from other people who are having.
That's right. It is a temporary solution. It just puts a Band-Aid on it. You're absolutely right.
Yeah. So really, I think some of the takeaways are, I think it'll be really interesting to see how this evolves. I mean, I think we're about to see, you know, maybe some dip in that net income figure, it looked like.
Yeah.
And we're not seeing labor really, I mean, it's slowing down, but it's not slowing down compared to revenue, which is falling. So it'll be interesting to see that go forward. And then, you know, really the messages I took were, you know, automate, offshore, manage, you know, train your labor, but there's no way around the fact that you're going to be paying more for labor going forward. It's just the automation isn't going to happen fast enough.
Well, and the people pushback of, oh, well, when I train somebody, they end up wanting more money and they move to somebody else. Welcome to the reality of training.
Yeah, exactly.
But what's worse is you could have somebody, you either don't have an employee or you have a poorly trained employee.
Yeah.
Both of those are worse.
And if you can locate near a Sun City, right? Is that like, try to get some old people to work for you. And then got one inquiry is like, there's a lot of content here. Is there another book cooking on that?
Not at the moment. I'd say, more so, we're going to try to do this once a quarter. But if you want it monthly, you have to be one of the Simple Numbers consultant clients. But it is like drugs. I mean, once our clients hear about the information, then usually kind of becomes the first thing we want to talk about on calls is, hey, what are you seeing? And it helps us. I mean, we also get to see it's a kind of a, give and take. I mean, the clients, provide us information that we can pass along, what's happening. And I think that's really kind of the hunger out there is people want to have a little more reality of what do you see that's really happening? And hey, we'll apply our own filters to, smoothing for inflation or, statistical, manipulations. It's like they used to say, there's lies, there's damn lies, and then there's statistics. And, and so just give me some data and tell me the context of where it came from. That's what we've done. And I think people have found that that's been pretty useful.
Yeah. Well, excellent. That was great. So I think we are at time just over. And thanks, Greg. That was great. And look forward to the next update.
All right. Sounds good. All right. See you, buddy.
We'll send out the video shortly for everyone.